Hello everyone, welcome to our presentation on understanding depreciation. My name is Saurav Ranjan, and I am representing Options and Ideas Financial Services. Today, we'll delve into the concept of depreciation, its importance, methods, and how it impacts financial statements. Depreciation definition. Welcome to slide 2, where we will define depreciation. Depreciation is the decrease in the value of physical property due to physical or economic reasons. Physical property includes both tangible and intangible business property, excluding real estate. This concept is crucial because it helps businesses understand and record the reduction in value of their assets over time, ensuring accurate financial reporting. The meaning of depreciation in the IT Act. Now, let's explore the meaning of depreciation in the context of the Income Tax Act. Depreciation, in accounting terms, is an amount that tax laws permit a taxpayer to deduct from taxable income. For tax purposes, investment in a depreciable asset is treated as a prepaid expense, and depreciation allocates this expense over time. Although depreciation is not a cash flow, it is considered an expense for income tax purposes. This deduction decreases net taxable income, reducing income taxes and making more funds available for reinvestment or dividends. Because of the time value of money, it is generally desirable to take larger allowable deductions in the early years of an asset's life, and smaller deductions in later years. This method helps businesses account for the reduction in value of their assets over time. Purpose of depreciation studies. Moving on to slide 4, let's discuss the purpose of depreciation studies. Depreciation serves several important purposes. It provides for the replacement of tangible property. It allows for the recovery of invested capital. It enables the cost of depreciation to be charged to the cost of manufacturing products or services rendered. Additionally, it provides tax benefits through deductions. Understanding these purposes helps businesses manage their assets and finances more effectively. Depreciation methods, straight line method, SLM. In slide 5, we will look at the straight line method of depreciation. This method calculates depreciation by dividing the cost of the asset by the number of years of its useful life. The same amount of depreciation is charged every year, and at the end of the asset's useful life, the book value of the asset is 0. The formula used is total cost of acquisition minus residual value divided by the estimated life. The rate of depreciation is calculated as depreciation rate, R, equals the amount of depreciation, R, divided by the acquisition cost, C, times 100. SLM calculation. In slide 6, we provide an example of the straight line method calculation. Suppose the total depreciable amount is 60,000 rupees, and the residual value is 10,000 rupees, resulting in a depreciable amount of 50,000 rupees. If the useful life of the asset is 5 years, the depreciation rate per year would be 20%, and the annual depreciation would be 10,000 rupees. Declining balance method, WDV method. Slide 7 introduces the declining balance method, also known as the written down value, WDV method. This method assumes that the depreciation charge for a given year is a fixed percentage of the book value at the start of the year, resulting in a decreasing depreciation charge as the asset nears the end of its useful life. The formula is cost of asset minus salvage value times the rate of depreciation. The rate of depreciation, R, is calculated using 1 minus north root of S divided by C times 100, where S is the residual value, C is the cost of the asset, and N is the useful life of the asset. WDV calculation. In slide 8, we will illustrate a calculation using the written down value method, providing practical insight into how this method is applied. Please look into and understand its insights. Sum of the year's digits depreciation, SYAD. Slide 9 explains the sum of the year's digits depreciation method. This method involves listing the digits corresponding to each year of the asset's life in reverse order. The depreciation rate for a given year is found by taking the corresponding number from the reversed list and dividing it by the sum of the year's digits. The formula is remaining life of asset divided by sum of the year's digits times the depreciable amount. For instance, for an asset with a 5-year life, the sum of the year's digits is 15, 1 plus 2 plus 3 plus 4 plus 5. The fractions for depreciation are 1/5, 2/15, 3/15, 4/15, and 5/15. Plant asset, computer depreciation method, SEAD method. In slide 10, we provide an example of using the sum of the year's digits method for a computer as the plant asset. This practical application helps plant asset, computer depreciation method, SEAD method. Units of production depreciation. Slide 11 covers the units of production depreciation method. Unlike time-based methods, this approach bases depreciation on the asset's usage or output. Depreciation is charged in proportion to units of production, usage time, or work performed. The formula used is cost of asset minus residual value, divided by total estimated production times actual production. This method is particularly useful for assets whose wear and tear are more closely related to usage rather than time. Units of production calculation. In slide 12, we present a calculation example using the units of production method. For instance, an automobile will wear out faster if driven 80,000 miles a year compared to 60,000 miles. This example demonstrates how depreciation varies with usage. Depreciation rates as per the Income Tax Act. Slide 13 provides an overview of depreciation rates according to the Income Tax Act, which varies based on the type of asset. Understanding these rates is crucial for accurate financial reporting and tax planning. Impact of depreciation on financial statements. Slide 14 discusses the impact of depreciation on financial statements. On the balance sheet, depreciation reduces the book value of assets. The book value is the asset's original cost minus accumulated depreciation. Over time, as depreciation is recorded, the book value of the asset decreases. Income statement. Depreciation expense on the income statement reduces taxable income, aligning with the matching principle in accounting. This ensures that expenses are matched with the periods benefiting from the asset's use. Cash flow statement. On the cash flow statement, depreciation is a non-cash expense. It does not involve actual cash outflow during the period it is recorded. Instead, the cash outflow occurs when the asset is purchased. Depreciation is added back to net income in the operating activities section because it does not reduce the actual cash available to the company. Conclusion. To conclude, depreciation is an essential aspect of the Income Tax Act, allowing businesses to recover the cost of their assets over their useful life. The depreciation rates vary based on the type of asset, and it is crucial to use the correct method of calculation. Claiming depreciation comes with specific conditions, and it cannot be claimed on certain assets like goodwill and land. Compliance with depreciation regulations is vital to avoid legal issues and ensure smooth business operations. Contact us. Thank you for your attention. For further information, please contact Options and Ideas at 25 Elgil Road, flat number 1A, ground floor, Kolkata 700031. You can reach us at 9330036513 or 033240502124. Visit our websites at http://www.optionsandideas.com or http://www.optionsandideas.org. We look forward to assisting you with your financial service needs.